A relative of my wife asked me the other day at a party that they're getting a $15,000 bonus. They're getting a $15,000 bonus from work. And they wanted to figure out what should they do with that $15,000 bonus. Not a $15 bonus, $15,000 bonus. And right from the get-go, they said, look, roughly a third of that is going to have to go to taxes. So this is going to be a $10,000 after-tax bonus. So this is the actual amount of money they'll have to play with. And they said they have a couple of options there. They have $200,000 on their mortgage, on their home mortgage, and they're paying a 6%. This is kind of the pre-tax 6% interest on it. They have a $10,000 car loan, and it's a 6% interest on that as well. Or they could invest with an expected return of 7% in the market. And you have to say expected return because in the stock market, it definitely is not a guaranteed return. Now, the first thing that when we talked about this is, well, let's just make sure that everything is kind of on the same kind of pre or post-tax basis. Or another way to think about it is, essentially, what is the effective interest rates or the effective returns to you once you factor in taxes? And the reason why this is important is mortgage interest is tax deductible. You can reduce it from your stated income, and so whatever your marginal tax rate is, you can get roughly that percentage back. So if this guy is being taxed at around 1/3 of his income, at around 33%, his effective mortgage interest rate, he's going to get about a third of this back. This will he'll be able to deduct all of the interest from his income. About a third of that back will lower his actual tax amount. So his effective interest rate is actually closer to 4% on his mortgage when you view it from a after-tax basis. The car loan is not tax deductible. You can't deduct more car loan interest. So its effective tax rate, its effective interest rate is still 6%. And on any kind of return you get in the market, depending on whether you think it's going to be short-term or long-term return, you still will have to pay taxes on it, although there'll be slightly different rates for that. But we just for the sake of this argument, let's assume that on an after-tax basis, so this would be pre-tax, he could get 7%, but then after-tax, let's say it's closer to 5%. And when you view it this way, now everything, the 4%, the 6%, and the 5%, these are all kind of net of taxes. And when you view it this way, what you should always do is pay off or invest in the thing that's going to get you the highest return. And sometimes you have to adjust for risk. In this situation, the costliest thing he has is this car loan. It is a 6%. It is a 6% car loan. It's even higher in interest than his after-tax return he would expect to get in the market. So the no-brainer thing to do here, and this is guaranteed. He's guaranteed to save 6% a year on this $10,000 loan if he were to pay it off. If he were to invest in the stock market, he's not even guaranteed that 5%. It might be more, it might be less. There's some volatility. And there's no reason to do the mortgage because he's only guaranteed kind of saving 4% on this $10,000 he would pay off. So in this case, definitely go for the car loan.